The stock market is like a giant shop. Here you can buy and sell pieces of companies. These pieces are called stocks or shares. When you buy a stock, you own a tiny part of that company. The stock market lets companies grow by selling shares. It also lets everyday people invest and potentially grow their wealth. Think of it like buying a cake. You can buy the whole cake or you can buy a slice. The stock market is where you buy slices of companies. And just like a cake, the value of a slice can go up or down depending on how much people want it. This makes the stock market exciting and potentially profitable. Imagine a giant auction. That's what the stock market is like. Buyers and sellers come together to trade stocks. They agree on a price, and the trade is made. These trades happen on stock exchanges, such as the London Stock Exchange or the New York Stock Exchange. You don't need to go to a physical exchange to trade stocks. You can do it all online through a broker. Brokers are like your agents in the stock market. They execute trades on your behalf. When you buy a stock, your broker finds a seller. When you sell, they find a buyer. It's all done electronically and happens very quickly. There are many different players in the stock market. You have individual investors like you and me. They buy and sell stocks for their own personal accounts. Then there are institutional investors. These are big players like pension funds, insurance companies, and mutual funds. They manage large pools of money and are very active in the market. Market makers are like the referees of the stock market. They ensure there's always a buyer and a seller for every stock. They provide liquidity to the market, making it easier for you to buy or sell when you want. And finally, we have regulators like the Securities and Exchange Board of India or the US Securities and Exchange Commission. They oversee the stock market and ensure that everything is fair and transparent. You can invest in the stock market in many different ways. The most common way is by buying individual stocks. This means you're buying a small piece of a specific company. Another popular option is exchange-traded funds, or ETFs. ETFs are like baskets of stocks that track a particular index, like the FTSE 100 or the S&P 500. If you prefer a hands-off approach, you can invest in mutual funds. These are professionally managed funds that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Bonds are like loans you give to a government or a company. They offer regular interest payments and are generally considered less risky than stocks. Real estate investment trusts, or REITs, allow you to invest in real estate without buying physical property. REITs own and operate income-producing real estate such as shopping malls, office buildings, and apartments. Section 5. Understanding common stock market terms. To navigate the stock market effectively, it's essential to understand some common terms. A bull market represents a period of rising stock prices, generally characterized by optimism and investor confidence. Conversely, a bear market is characterized by falling stock prices, pessimism, and economic slowdown. An initial public offering, or IPO, is when a private company first offers its shares to the public. It's an opportunity for early investors to buy into a company before it's widely traded. Dividends are a portion of a company's profits that are distributed to shareholders. They provide a source of passive income for investors. Market capitalization, or market cap, refers to the total value of a company's outstanding shares. It's calculated by multiplying the stock price by the number of shares outstanding. The price-to-earnings, or PE ratio, is a valuation metric that compares a company's stock price to its earnings per share. It helps investors determine whether a stock is overvalued or undervalued. Volume refers to the number of shares traded in a particular stock or the overall market during a given period. High volume indicates strong interest in a stock. Volatility measures how much a stock's price fluctuates over time. High volatility means the price can change dramatically, while low volatility suggests more stable price movements. Section 6. Why do people invest in the stock market? People invest in the stock market for various reasons. One primary motivation is wealth creation. Investing in stocks offers the potential for long-term growth and the opportunity to build significant wealth over time. Retirement planning is another crucial reason. Investing allows individuals to accumulate savings and generate income for their retirement years. Investing also helps beat inflation. Inflation erodes the purchasing power of money over time, but investing can outpace inflation and preserve the value of your savings. Many investors seek passive income through dividends. Dividends provide a regular stream of income, even if the stock price doesn't move significantly. Section 7. How to get started with investing. Getting started with investing is easier than you might think. The first step is to choose a brokerage account. A brokerage account is like a bank account for your investments. It allows you to buy and sell stocks, ETFs, and other securities. Once you've chosen a broker, you'll need to complete a Know Your Customer, or KYC process. This involves providing some personal information and verifying your identity. It's a regulatory requirement designed to prevent fraud and money laundering. With your account set up, you can fund it and place your first order. You can choose to invest a lump sum, or start small, and invest regularly through a systematic investment plan or SIP. Investing regularly through an SIP helps to average out the cost of your investments over time and reduces the impact of market volatility. Section 8. Exploring different investment strategies. There are numerous investment strategies to choose from, each with its own risk profile and potential returns. Long-term investing involves holding investments for extended periods, typically years or even decades. This approach aims to benefit from the power of compounding and ride out short-term market fluctuations. Swing trading is a more active strategy that involves holding investments for a shorter duration, typically days or weeks. Swing traders aim to profit from price swings within a broader trend. Day trading is the most active form of trading, where positions are entered and exited within the same trading day. Day traders aim to capitalize on minute-by-minute price movements. Value investing involves finding undervalued companies with strong fundamentals and the potential for future growth. Value investors believe the market often misprices stocks, creating opportunities to buy low and sell high. Index investing is a passive strategy that involves tracking a specific market index, such as the FTSE 100 or the S&P 500, by investing in an index fund or ETF. This approach provides broad market exposure and aims to match the performance of the underlying index. Section 9. Potential risks and common mistakes to avoid. While investing offers significant potential rewards, it's essential to be aware of the risks involved. One common mistake is trying to time the market. Timing the market perfectly is incredibly difficult, even for experienced investors. Instead of trying to predict short-term market movements, focus on long-term growth and invest consistently over time. Another pitfall is following tips or news hype blindly. It's crucial to conduct thorough research and due diligence before making any investment decisions. Don't rely solely on rumors or hearsay. Lack of diversification is another common mistake. Diversifying your portfolio across different asset classes, sectors, and geographies helps mitigate risk. Emotional investing can lead to impulsive decisions and poor outcomes. It's important to stay disciplined, stick to your investment plan, and avoid making emotional trades based on fear or greed.